Imagine this. You walk into your school cafeteria and suddenly everyone, literally everyone, is crowding around one table. Nobody cares if there's no space. Nobody cares if they don't even know the people sitting there. They just want to sit there because it's the cool table. That's exactly what's happening in the stock market right now. AI has become the cool table. Every investor, every company, every influencer, every startup founder wants to sit there whether they belong or not. Stocks linked to AI are exploding. Billions of dollars are being thrown into projects that don't even make money yet. Governments and central banks are warning that the hype might be running out of control. So today, let's break this down clearly. What's actually happening in the stock market, what the AI bubble even means, why people believe in it so strongly, and why experts are still warning that it could burst. And I'm going to explain this in the simplest, most teenager-friendly language without losing the depth. Part 1. What's actually going on right now? Over the last few years, AI went from being interesting tech to the next industrial revolution. Companies are rushing to buy GPUs, build data centers, and launch AI products. Investors don't want to miss the next big thing, so they pour money into anything that mentions AI. And because so much money is chasing so few companies, stock prices shoot up, sometimes with no real justification. It's the exact same psychology we use as teenagers. If everyone's buying it, I should buy it too. That fear of missing out is a dangerous fuel. Part 2. What exactly is an AI bubble? Let's simplify this completely. A bubble forms when people buy something not because it's valuable today, but because they hope someone else will pay more for it tomorrow. Imagine buying a Pokemon card for $50, even though you know it's worth only $10. But you buy it anyway because someone told you, don't worry, tomorrow someone will buy it for $70. That's how bubbles work. In the AI market, the same thing is happening. Startups with barely any product get billion-dollar valuations. Companies with tiny revenue are priced like future monopolies. Investors assume AI will take over everything, so paying crazy prices feels logical. But this logic depends 100% on belief, not on numbers. And belief can disappear overnight. Part 3. Why people believe AI deserves the hype. Now, here's where it gets tricky. AI isn't a scam. It's not just hype. AI is generating real money. GPU manufacturers are earning billions. Cloud companies are selling AI services at huge scale. Enterprises are saving time and money using AI tools. Unlike past bubbles, AI actually solves real problems and delivers real results. That's what makes this bubble different and even more dangerous, because you can't dismiss it as just hype. There is real value here. But here's the uncomfortable truth. Real value doesn't automatically justify insane valuations. Part 4. So why are experts worried? Because when you zoom out, you start noticing cracks. First crack. Too much money chasing too few winners. Everyone is pumping money into the same 5 to 10 companies. It's like the whole stock market is standing on a single thin branch. If that branch snaps, the entire tree shakes. Second crack, prices rising faster than revenue. Some AI companies barely earn anything, yet their stock prices act like they're already the next Google. That mismatch is classic bubble behavior. Third crack, startups valued like superheroes. Many early-stage startups with zero profit are valued at hundreds of millions of dollars. Imagine your friend opens a lemonade stand and investors say, here's $200 million because one day your lemonade might change the world. That's exactly what's happening. Fourth crack, insane spending with uncertain payoff. AI demands huge investment, enormous power, expensive chips, massive data centers, huge training costs. But nobody is sure whether revenue will recover those costs fast enough. This imbalance is dangerous. Part 5. What happens if the bubble bursts? When bubbles break, they break fast. All it takes is one trigger. A big AI company misses earnings. Regulation slows AI deployment. Funding tightens. A new technology disrupts current models. Once that spark hits, investors panic. Stocks fall sharply. Startups can't raise money. Expansion plans get canceled. Layoffs begin. The hype disappears. This exact pattern happened in the 2000 dot-com crash. And right now, the AI market is showing similar symptoms. Part 6. So, how should you think about all this? Here's the truth people won't tell you. Most people chasing the AI trend will get burned, not because AI is fake, but because they follow hype instead of understanding value. If you want to survive and win in this era, think differently. 1. Don't invest in anything just because it screams AI. Hype companies collapse the fastest. 2. Focus on real adoption, not flashy demos. If businesses aren't using a tool daily, it won't last. 3. Stick to companies with real revenue and cash flow. These are the ones that survive recessions and corrections. 4. If you're building, solve real pain, not imaginary future problems. Products that save time or money will always survive.